Oh, that we were perfectly rational, especially when much is on the line, like our investments. But we're not. Instead, we exhibit certain common predispositions in our thinking. We have emotions, we have quirks, and of course, that's called being human. But if we knew what these quirks, emotions, and predispositions were in advance, might we be able to recognize and avoid them when they clamor to overrule or derail our rational financial decision making? Stay tuned as we explore the curious world of behavioral finance right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Erik Olson and Adrian Nicholson. I say as always, although Erik, you weren't with us last week. You were at a conference.
I was at the conference and I tried so hard. Once again, it seems like we've had only one success with me trying to connect via internet with you guys when I'm at these conferences. The hotel Wi-Fi is just not getting the job done. So I think I should probably either just do a dial-in or just write it off as a week I can't make it. But thanks for carrying the show, guys. I did listen to it, and it sounded great.
Yeah, definitely an interesting topic last week as we bumped this one out a week to address it. And I think we've got another good one today. Today we'll be talking about behavioral finance. And Erik, why don't you kick it off?
Sure. Well, one of the things I think all of us recognize in ourselves is that we're not entirely rational in the way that we make decisions. And sometimes that's inconsequential, right? So, for example, hey, where do you want to go for dinner tonight? I don't know, pizza, Mexican, Chinese, whatever, it's not going to be a big deal. I think that a lot of our behavior follows what the social scientists will call satisficing. If it's the first thing that surfaces or the first idea or the first option that meets some sort of minimal sort of qualitative criteria that we've established, we'll go with that and economize instead of doing, let's say, a half an hour analysis on all the restaurant choices that we could possibly take advantage of before we make a decision on it. And that's fine. Economizing measures in our decision making all the time makes a lot of sense. But sometimes our departures from what I would say rationality in our decision making can be very costly for us. And that's particularly true when stakes are pretty high, such as in the area of finance. Now, I suppose we could venture out into some other areas of life as well, the choice of a marriage partner or things of that kind. But in this particular case, it can be costly if we aren't aware of the sorts of biases that are influencing our decision making in an adverse way. So what we thought we would do today is just highlight some of these I would say common biases, and then recognizing those biases hopefully allows us to do a little bit of a check on our tendency to follow that impulse when the moment of truth is facing us, particularly when the markets are under strain or stress as they've been over the last few weeks here, and where the tendency sometimes is to say, hey, I'm feeling uncomfortable, I need to make a change, what should that change be? So that's what I would say. In essence, just understanding what those biases are will help us hopefully not be overcome by those biases.
Yeah, and even before we get deep into the biases, the fact that this exists, this field of study of behavioral finance, and what this is, just the definition, it's the study of the effects of psychology on investors and markets. And the beginning of this goes back to when there was a study on efficient market theory, and the fact that you've got humans that are buyers and sellers in this market, that their biases would then impact the price. It'd be an argument against the efficient market hypothesis. However, that's not our topic for today, arguing that or not. It just shows that this field of study sprang from that, and knowing that it exists, I think, is valuable on its own, particularly in a time like right now when the markets are down, the S&P down a little under 10 and the NASDAQ down a little under 14 as we speak today, early in March of 2022, how people will react, what their thoughts and feelings are. I think acknowledging that those thoughts and feelings are okay, but then trying to not necessarily have the emotional side affect your investment decision.
Mm-hmm. Yeah. Good. Well said. So what were some of the key biases that surfaced for you?
Well, the most frequent things I saw on there were just a list of these. But I'll actually take one more step back and ask you a question before, and I'd love to hear both of your reactions on a significantly down day of the market. You leave the office. Markets close at 4. You leave the office whenever you're done, 4, 5, 6 o'clock, and you head home. Do you find that your mood is impacted? Are you a little happier on up days and a little unhappy on down days?
Adrian, how about you?
Yeah, I'd be happy to start this one out. It's a pretty easy explanation to this, where you could just kind of boil it down to it's a win or a loss. Obviously, people are happy when they're win or when something positive happens or a good outcome happens, compared to a loss or something bad happening or something not going their way, I think is kind of the answer to this. But when it comes to this area, I think it's interesting because you're really taking the numbers out of this, where it's more on an individual level, how individuals with their past experiences, who they are, where they come from, their background, is a really driving force in this area of behavioral finance, where everybody's going to be different. Everybody's going to take it a different way, where if it's a really down day, some people, depending on what their situation is, are going to react differently or have a different mood than somebody else. Some people might be able to brush it off saying, oh, it's just a blip in the market, or my overall situation can handle this, where some people, it might be the opposite, where they are wondering, how am I going to recover from this? They're going to look for the next update. They're going to try and find whatever they can to make this bad situation into a good one, where this is a very personal and individual area of finance. I think is really interesting, where you can't really use numbers to kind of quantify people's different reactions. I think is really interesting.
What about your reaction though? When the markets are down, or let me flip the question. When the markets are up, are you in a better mood than when the markets are down?
Well, in this industry, you'd always like to see the markets go up, but I think one of the best things you can kind of teach yourself and be disciplined about is always look at the bigger picture here. Multiple bad days or just one bad day, or kind of looking to the reasoning, kind of looking at the macroeconomic effects on why this is happening, other than just kind of looking at it saying, oh, the markets are red today, that's bad, or the markets are green today, that's good. Where if you kind of try and stay as objective as possible and kind of stay the course, it's easier for me to see a bad day, maybe draw some good things out of it, or if there's a good day, looking at the reasons behind it, have maybe an opposite impact on that. So I know I'm kind of giving you a very neutral answer, which you don't like, but I think it's more important to just look at the bigger picture here.
I don't disagree with you with looking at the big picture, but I will move on to Erik with my question.
When the markets are down,
how about you?
When the markets are down, I feel bad. That's my simple answer. The one inflection on that answer, I guess, is I also do weirdly think of it in relative terms. So if the markets are down X percent, but my own holdings are down less, I actually don't feel quite as bad. I feel like, okay, good, diversification is working. How about you?
Yeah, well, and I definitely feel bad when things are down, markets are down, and I try to cheer myself up on the commute home with music so that I don't come in as a monster to the house.
And Roshan, I'm just curious, what do you like the term you're using, bad? Just explain that more. I think that's also interesting when it comes just emotionally how people handle situation. You can just say, oh yeah, I feel bad when the markets are down, but does bad mean that you walk out the door and the next, like a minute later, you're just not thinking about it. Or I think that's something that people kind of have to define in their own way. And there's different levels to it, obviously. That's why I agree with Erik. The simple answer is, yeah, when the markets are down, people are like, yeah, I feel bad. When the markets are up, yeah, I feel good. But I feel like so much more into it, where we're not like robots, where everyone has the different reaction, different take.
Okay, so and I can answer that more specifically then. If it's a slightly down day that's not much, I probably won't notice it. A really big down day, I play my music and I either need a drink or to hit the gym. those are my paths. And
Okay,
in between that, music on the car ride home, and before I can hit the gym or have a drink, I've got to go home and act like a normal person for dinner, bath, and bedtimes with the kids. So there's my answer for you. Now, going back to what both of you said that I think is very important, though, is no decisions are made. It's just how to manage stress, right? And so I think that's what Adrian, when I'm going to say you gave me the politician dance around the question answer, and Erik, when you gave me the way you think about an answer, I think that's the important part right there of behavioral finance, because I mean the three of us, we're seeing these things happen in real time, and I don't mean by the day, I mean by the minute. Like, I'm thinking of last Thursday when the Russian army invaded Ukraine and the markets opened up down 3.5% roughly, ended up 3.5%. We rode that roller coaster minute by minute, and that is definitely a stressful situation, nauseating situation to be in. But I think what we've all touched on is we're not reacting or adjusting things, running out of the office or anything like that based on that. And to me, that's the important part about behavioral finance, right? Is saying, the market's going to have up days, you'll probably be happier. The markets will have down days, you'll probably be less happy. But your decision making should not be driven by what the market did on any particular day. So acknowledging that behavioral finance exists, it's a field of study. It's okay to feel these emotions when the markets are moving, but continue to make your decisions rationally and not emotionally is the key. So that's why I wanted to start with that question. For one, to ask, hey, am I the only one? I didn't think I was, but I wanted to verify that. And two, just get your thoughts and feelings on there. Now, I took us a long way to get Erik to your question of going over some of the biases that are out there and how they can affect people and their decision making with the investments, or how to manage them. And there are multiple lists, so we can throw out a few, but I'll give the first one on this list. We will share all of our resources as we always do in the show notes. This one is from a Business Insider article, and one of the first ones they have on there is overconfidence bias, the tendency to think we know more than we do. I think that's a big one in this field in general, because especially if we break it down to an individual stock level, we do a ton of research, right? So we believe in our ideas, we have conviction behind what we've done because of our research, but at the same time, you don't want to get overconfident. Do either of you have any suggestions, thoughts, or ideas on how you can manage that?
Well, in terms of the overconfidence, I would say it's one is just to look outside the normal sources of data that you normally consult. I think at least in my case, I think I tend to look to certain sort of because of a philosophy or a worldview related to investment, I look for certain sources of information and not others. And it's because first of all, the number of sources of information are limitless. That's one issue, and the second is knowing how to correctly weigh them. And so simplifying the process of of reaching conclusions from all of that, usually in my case, leads me to sort of default to the normal investment beliefs that I brought with me when I started the analysis in the first place. So I have these biases, and it's those tend to confirm. We have a tendency, another sort of sister bias of the one that you've outlined is known as confirmation bias. We tend to see things that align with our outlook or that validate our outlook as more weighty in terms of their significance in our decision than those things that disconfirm our prior assumptions.
Yes, that is the next one. The next one I was going to go over because they line up so well. That confirmation bias, where you're looking for information and data to confirm your thought or decision. And
Mm-hmm.
I think this is very interesting because I'm not, I'd say I'm guessing, but I'd say I'm probably the least active on social media of the three of us. I would guess, Adrian, based on your age, you'd be the most. And Erik, I'm only giving you more than me because I'm so little on
Mm-hmm.
there.
Mm-hmm.
But
Mm-hmm.
I've read and heard a lot about how that's one of the major risks of that. And with social media, you can have anything you're interested in. So I know that like there are different stock groups. Actually, um, last year, Wall Street Bets made a lot of news with what they did with GameStop and
Mm-hmm.
um, and some of the other stocks. But just this risk of getting a feedback loop that tells you what you're looking for and confirms what you're looking for versus looking for the opposite. I remember years ago, I wish I could remember who this was, but an investment manager said before they actually make a purchase on any security, they try to find what the other side of the trade is
Mm-hmm.
saying, just
That's
knowing
interesting.
that someone's
Mm-hmm.
selling when you're buying.
Mm-hmm.
So seeking out how you could be wrong as opposed to seeking out how you could be right. Now, the tough part is there's not always information on that, right?
Mm-hmm.
On the how you could be wrong aspect. But I wish I could remember who it was. I just know it was a big money manager that could have people answer their phone calls to tell them, the other side of the decision
Mm-hmm.
or the other analysts.
Yeah, well, we have talked about this sort of overconfidence or at least a confirmation bias in our own cases earlier. We had this conversation, I don't know how many shows ago, 20 or 30 shows ago, but it was at least in my case, I acknowledge that coming right out of the economic or the financial crisis of 2008, I really was of the view that the initial rebound in March, beginning in March of 2009, and running into mid 2010, 2011 even, was mostly a dead cat bounce, and that we would probably have, just to the same extent that we had gotten to such excessive valuations prior to that point, we were likely to see the pendulum swing further toward undervaluations. And as a result, I was very cautious about making sure that we had a lot of diversification and even some what I'll say long short positions in clients' portfolios, so that we didn't get burned by another big downturn like that. Well, that in retrospect, what I hadn't taken into account was just the power of the Federal Reserve and the magnitude of the quantitative easing program that they would institute, and as a result was for a long time not sufficiently engaged with the categories of investment that were the most rewarded during that period, which for the most part were U.S. stocks and particularly large U.S. stocks. So the combination of looking at valuation tables and saying the valuation tables say we're still at elevated levels, I allowed that sort of input into my assessment to weigh more heavily because it aligned with my prior bias.
Yeah, and I think let's go a little bit further into that, Erik, because there is knowledge you gained from that, and I had a
Mm-hmm.
very similar experience. But tell me about that. What's the lesson you learned, or what are the adjustments you made to make sure that kind of thing didn't happen again to you?
Yeah. Well, the lesson for me was that I had to have um, less of a sort of a, what's the word I'm looking for here? accept the fact that there needed to be, I guess the answer is I accepted that there would be more risk in investing, that I couldn't diversify away all of the risk in clients' portfolios, and at this point make sure that I had a sufficiently strong presence in all of the various categories of the markets, if you will, in such a way that yes, there would be some losers in the portfolio, but there would also for sure be, by participating in all the various market categories, including large cap and including the growth side, as opposed to hugging more on the smaller cap on the value side and on short positions, that I thought at that point, the remedy was to just have a greater diversification. And I'll mention just another sort of lesson in all of that. Starting in probably 2018, mid 2018 through, we've had a conversation incidentally on this topic as well in previous episodes, but starting from mid 2018 through probably mid 2020, you had the outperformance of growth stocks relative to value stocks was just unreal. It was more divergent than at any point, I think, in measured U.S. market history. So it just reached such extremes in the divergence of their performance. And so there too, my bias toward, as a value investor, my bias toward value and my bias toward small was penalized. And in this case, I would say, yes, I was diversified, but part of me thought, all right, maybe there's a different approach here where rather than remaining diversified all the time, the better solution is to tilt toward the things that are working now, which I think is actually a position I've heard you, Roshan, articulate more so even than I have ventured to do, which is you have explained that you're not that keen on having an emerging market investment presence and have a relatively small allocation to international, at least smaller in both cases than mine. And so I think in that sense, whatever has kind of driven your thinking in that direction has also as well started to influence mine, again, causing me to question those assumptions of those biases that I bring to the table and that have led me to, a position of overconfidence about the view. I guess the simplest version of this view is small value will prevail. Small value will prevail. Small value will prevail. Well, it probably will in the long run, but it's not right now. So why stay with that?
Yeah, and I'll tell you that. So that bias that you had mentioned that you had, I did as well after coming off the market decline. And tell me if you would classify it differently. That to me is more like a recency bias where you just had seen the market decline and you just couldn't believe that it would recover. I had a similar thing, and the adjustments that I've made since then are, one, to have multiple strategies so that if that bias does exist, it will only exist in a portion of your portfolio. And two, what you had mentioned about international and emerging markets is I try to look at that exposure through one of my strategies, which is the momentum one that we have. And in that one, they have to start outperforming. They are expected to, and they have been for years, and they're undervalued. I know the old joke, this was probably in the mid 2000s, was emerging markets have yet to emerge or something. I won't get the date right, but it was something to that effect. But it underlines what you said about the timing, right? You don't know when they will actually shift and when things will change, or when they'll recover. So that's why I think for me, I feel comfortable with having these multiple strategies, because you're able to, at the very least, minimize this bias risk, right? Because just what we just described. When I've got an algorithm that we have that will help select those sectors, none of the biases that I have will be impacted, right? It's it
It's
should
all
be
driven by
neutral.
math and an algorithm rather than by your outlook, and that is in fact why I've been running a tactical strategy since late 2012, in part to try to counter that. And incidentally, this is not a recommendation, folks. I'm just reporting to you as sort of a snapshot in time. What that is showing right now is primarily it's weighted toward commodities, and then a small bit toward three sectors in the U.S., which is probably no big surprise: consumer staples, utilities, and then finally exploration and production operations of oil companies. How about you?
Yeah, and I'm pulling this up. We do have energy in there, and what we have within our algorithm are different types based on risk tolerance.
Mm-hmm.
So
Okay.
those models will have different exposure to a certain degree. The sensitivity of when they adjust is different. But I'm going to look at the actual stock version, and we are looking at uh, uh, lithium as one of the
Mm.
positions.
Okay. Yeah. So
Growth
you have
stock,
some. Go
yeah,
ahead. Yeah.
growth stocks. Interestingly, Nasdaq, growth stocks, S&P, and financials.
Hmm.
We at some point it rotated out of energy on the more aggressive model, and that was not too long ago.
Hmm.
I think an interesting thing that our listeners would probably want to hear, and this kind of falls under, this is like a major topic in behavioral finance. If you have a strategy, or let's just say like a stock that has been performing really well, it's hard for you to, let's just say, sell that position or move away from that strategy. Or if you have and this is just like a concept, if you have a strategy that's underperforming, not doing well, or a stock that's not doing well, you'll be quicker to, let's just say, move on from it or sell it. What's kind of like the process when you have a discipline or a strategy or any type of theory that you've been using in investing, where it's kind of, you want to take away the bias from it and you want to be as analytical and do your research as possible? But what's kind of your like take or your advice to investors when they have this like strategy that, let's just say, is performing really well or not performing really well, just to kind of keep the bias of making a decision where this one's just been a winner, I'm going to keep it, this one's been a loser, I have to move away from it, where it's kind of hard sometimes for people to make that decision?
That's a good one. So with part of the value of the algorithm is I don't make those decisions on that part, right? So that's just going back to what I said earlier of
And that's
having.
you bring up a big point too, where now that people are relying more and more technology, it's kind of moving away from this behavioral side of finance where you're having these computers, these algorithms making the decision for you, which is taking out of that human element. But you could make an argument sometimes that human element sometimes can be a beneficial factor when it comes to investing. I think that's also a new concept that we should explore maybe in another episode, but that's
Well,
interesting.
my point was have it all, right? So with the algorithm portion, I don't have that there. With the portion of the portfolio where we utilize a modified version of modern portfolio theory, I also don't have that there. Now with part of the individual stock portion, I definitely have that bias there, and for me, um, an important statement that people have heard or said in the market in the past is you don't have to make it the same way you lost it, right? So if it is down and your belief or your thesis was wrong as to why you were investing, um, I think that's the point where you've got to sell it. And just to give a really basic example, let's say you bought a stock because you thought earnings were going to continue to grow, and all of a sudden earnings are declining. Well, if your whole reason of buying it was earnings growth and you're seeing earnings decline, I think you've got to make the sale of that position because it no longer fits the thesis. You were wrong. Earnings, you thought they were going one way, they'd go the other. So I would point, my answer to that would be it would go back to your research. Now, very often, though, if you're going to uh, buy a stock for uh, if you're going to buy an individual stock, I would encourage you to have a very long time frame, right? And I use that earnings example just because it was a really simple one. But to go a little bit further with that, if you thought the earnings were going to grow and they had one quarter where there was a miss, and then you research that and you find out, oh well, it was due to the pandemic and COVID, right? You may not want to sell at that point if you still believe in your idea. So one quarter of miss doesn't necessarily have to be a deciding factor for you. So Adrian, I don't have a simple answer to that, because I think in particular when you're looking at like individual stocks, every situation is different, and you've got to see if your thesis or your reason for investing has been proven wrong. If it has not been proven wrong, then I don't see a reason to sell.
So it is, Adrian, I think the hedge funds a lot of times are using an algorithmic approach where they're using technology, as you mentioned, and as a result, they are surmounting some of those, perhaps potentially those cognitive or behavioral biases that they themselves would possess, and their rules are meant to override their emotions or the finite limitations on their own ability to subjectively assess all of that information. But I think the individual investor is probably a different story. Now, even there, though, I'll say this: at the individual investor level, many people, especially, we talked about this in one of our episodes where we talked about target date funds. In their 401ks, which oftentimes represent one of the largest positions in their portfolios, many investors have been gravitating toward the use of target date funds, which themselves then they turn over the responsibility of choosing the allocation to some, well, in this case, the fund provider that which has a committee that then makes the allocations and modifications to that. I guess what I've seen though is when there's it's more limited somewhat, but certain clients that have developed a love affair with a particular stock. And in some cases, that's been rewarded. And because it's been rewarded, then there's a tendency oftentimes to want to continue with that particular stock. I think you're seeing that, for example, if you know anyone who's owned Apple for some period of time, or who's owned Facebook for some period of time, despite its recent trials, or Google or Amazon or some of these others. And yet, I don't know if the two of you, I imagine you have, but I mean, I also have situations where there were clients that had a love affair with a particular stock, and no amount of dialogue with them about the virtues of diversification was going to move them off of their overwhelming over allocation to this particular stock. And then, poof, the stock blew up. I think it's easy to sort of cite successes as well as failures, as opposed to the ones that are more sort of in the middle of all of those experiences. And I just cited some of the successes, but here's an example of a failure where the client had received a gift of some stock in a bank known as National City Bank. And that represented about, if I recall correctly, 70% of their net worth. And then the great financial crisis hit, and National City essentially went to zero, and so did then 70% of their wealth. And so on that basis, at least, I would say this tendency to have too great a confidence in this can never be derailed. This is for sure going to be the stock that we've ridden for decades so successfully. We're going to continue to ride it successfully for decades. I would say you're going to be happy if you're right, but you'll be deeply unhappy if you're wrong.
Yeah, I have similar stories of clients in the biotech space here in the DC metro area, in the Maryland, Gaithersburg, Maryland area. There were a few clients that were with the biotech that had done really well. They had a drug they were sure would get approved. It did. The stock went up, and then they found that insurance companies weren't willing to pay for it because it didn't really have a significant greater impact than the cheaper drugs that were now generic. And then the stock tanked, and a similar story. So yeah, that's a good way to point out some of the biases there. I'll give you, Erik, and I'm sure you tried this approach, I just want to mention it for anyone listening that's in a similar situation. What I try to do in a situation like that is figure out how much you could lose without impacting your life, and that would be your maximum position size. Now, I'm sure you tried that. I tried this with that client before, when I'm referring to the biotech, and it was multiple people. It wasn't just one, but they weren't willing to sell as well. And fortunately, it didn't really impact their life too significantly because they tend to be frugal. They do have a smaller house than they would have had they sold the stock, though. They were in the market for a house, and I was trying to get them. I was like, well, at least sell enough so you can get the house you want. But they're not unhappy. You know, they're fine. So their life is fine. Fortunately, they were younger as well. But the way that business model works, though, is they took about a 30 to 40% pay cut to work there in exchange for getting all this stock. So they ended up making less money, and the stock ended up not being worth anything either.
Well, so we've touched on a few of these biases, and I want to give some names to them. So one of them we've talked about is this recency bias. So whatever's been happening lately, we assume is going to continue to happen in the same way on a perpetual basis. We've talked about an overconfidence bias. We've talked about the and sort of touched upon a couple others, which is the endowment effect, it's known, and this is something where something that you presently own, you value it more than you value something that you don't presently own, even though there's no demonstrable superiority in its performance or its earnings power or its cash flow growth or anything else that might be an objective commentary about that. Just because you own it, it seems more valuable to you than some of the alternatives. What are some other of these biases, gentlemen, that you've chanced upon here in your research?
Well, one of them I'll throw out there is self-attribution bias, believing good investment outcomes are a result of skill and undesirable results are caused by bad luck.
Yes, yeah. If you want to elaborate on that one.
Well, first, I'll take luck any day of the week as long as it works in a profit. But it essentially gives yourself too much credit when you're right about an investment and removes all blame when you're wrong. I think you got to pick one side or the other. Call it luck in both cases, or skill right. Or lack thereof in both cases.
Right.
I agree, Roshan. I mean, it's a common term people are saying now. Just when something bad happens, they just say, "Oh, unlucky." But when something good happens, they'll explain why everything went in their favor, the outcome, everything that went into it. And then if it's like a loss or something bad happens, just don't even acknowledge it and just say unlucky and move on.
Yeah, and I'll say to my kids when they mention luck is I don't believe in luck. Because they'll say, if they say something's bad, like no, you did something wrong or you did something right. I don't believe in it. So I'll say that to the listeners as well. Now, I did start this out by saying I'll happily take luck, and by that I mean I'll take profits anyway. But I'd be on the when I said pick one side, either give all the credit to good or bad luck, or give all the credit to skill or the lack of skill. I tend to fall in the camp where it's skill / lack of skill that gets the all credit and all blame.
Well, I've got two more here. So one is the hyperbolic discounting, and I'll tell a story to go along with this. But that is the tendency for us to choose smaller and sooner payouts than payouts that are greater if we have to wait longer to obtain them. And that's understandable, because we do the conventional statement of this is the bird in the hand is worth two in the bush. Of course, there is that, and we use a discounting factor to express future cash flows in a present value framework. But this is the hyperbolic version of that, which really overdoes that. And I see this a lot in clients that, and not all clients, but some clients who are talking with me about Social Security. So we'll for all our clients run a Social Security optimization analysis, and then we'll examine how sensitive that assessment is to whatever assumptions that we used about life expectancies. And so they can see if they lived longer or shorter, how that, what might be the quote unquote optimal solution would vary. But what I've noticed, despite the demonstration of that optimal case in their particular instance, what I often have is clients saying, you know what, I'd kind of like to start that Social Security earlier. Why is that? Well, I'm just a little short on cash right now, and it would just feel better if I just could get that cash flow starting. And again, my commentary about that is okay, well, remember, this is not just, it's not just a one-sided analysis. It is what the rest of your assets, you're reluctant to tap more heavily your existing assets now prior to taking Social Security. But what that will mean is if you take Social Security sooner, you'll have less on a monthly basis for the rest of your life than you otherwise would have by waiting a little bit longer. And then you'll be drawing on that portfolio more heavily for the balance of your lifetime. And so we have to kind of look at the two things together. But there is that tendency to say, wow, I just don't want to see those dollars evade me. I want to get that cash flow started sooner. Do you find that as well?
I have definitely seen people like that where they also say, well, what if I die? And even though we have the assumption in there, that's the reaction sometimes. So yeah, I'd say the majority of people will look at the analysis and use that to make their decision.
Yes.
But there are definitely some where there's no deviating from their path or the decision they actually made. I think of one client comes to mind in particular where I was able to get her to go from 62 to 63, but by the time 63 hit, she was done waiting. And so we adjusted her plan and we said, here's the impact. The impact was not that significant. Fortunately, in her case, she had enough in assets to be okay, but it still was not the optimal decision. But she was comfortable with the, we compared the two, and she says, well, if that's the negative impact, I'm fine with taking that negative impact. And I think that a big part of what we do, I'll tell this to clients all the time, is we try to provide you the data to make your decision, right? We're not making decisions for you. We want to give you all the information so you can make a sound decision. And in her case, at the end of the day, even she had said, okay, I'm going to be a little less well off by making this decision early, but I want to make it early, and that's the difference is acceptable.
So I've got one more, and that's
Yes.
But I've if you've got one other that you want to introduce first, go ahead.
Go ahead. I've got a
All right.
list, and I'm just crossing things off.
Okay, it's the sunk cost fallacy. So what is the sunk cost? So I lost money on that. I don't want to sell it because I'm down in it, and I want to wait till it comes back. All right. Well, you're already down in it. We can't rewind the hands on the clock. So now the question is your better choice to stay in that particular position and hold it till it recovers, or switch to something else that has potentially a better chance of recovering than the one you're holding does? Because it's your only concern isn't your concern should be I came down the hill. How do I get back up the hill? It doesn't matter if it's on the same bus. Probably not. If another bus will get you to the top of the hill sooner than the bus that you're on that's broken down, why not catch it?
Yeah. That is always a tough one. And I had mentioned earlier, not with the bias name itself, but that you don't have to get it back the way you lost it.
Right.
That's an important one to figure out. And a lot of this, a lot of the solutions, I think, what do you do about this is always what I'm looking for, and I want us to always share that to everyone listening. A lot of the answer is it comes before you make the decision. Why did you buy this? And is the reason you bought this still intact? If that's the case, I don't think, even if it ends up being a slower bus, if that's the case, I think that the decision to hold is a good one. And also, with that being said, when you're doing your analysis and research at the beginning, um, the answer can't be I'm buying it because the price is X, right? It can't be stock price driven. It's got to be about the company, um, or the investment itself. But that being said, I think you've got to, at the beginning, know why you're making these decisions, have a framework that helps you decide those decisions, and if your thesis has been proven wrong, that's the point where I think you've got to switch the bus you're on.
Mm-hmm. Mm-hmm. I think this is true also. The same application of this same principle is true in so many other areas of life. That is, for example, if you're running a business and you find yourself just pouring money into this business and it doesn't seem as though it's ever going to turn around and become profitable, or at least not in the near future, do you continue to put good money after bad? Or do you just say, I'm going to just count all of that as it didn't work out, I'm going to cut my losses, and now I'm going to go ahead and start fresh with a different business idea?
Yeah, yeah, and you'll hear that oftentimes from anything you look at or read entrepreneurially um, about businesses pivoting, right?
Mm-hmm.
And
Mm-hmm.
I think Amazon's a great example because they made so much of their money. Um, they made so much of their money with their retail side of the business, but their most profitable part of their business now is their Amazon Web Services that sort of was an ancillary business because they had excess capacity,
Mm-hmm. Mm-hmm.
right?
Yeah.
So that pivoting not only works for those companies, it can work for the stocks you're looking at.
Mm-hmm. Mm-hmm. Do you have other fallacies that are or behavioral biases that you wanted to introduce here as well?
Well, I do. I just have a quote I want to share from Warren Buffett's recent annual letter that lines up with our conversation about the buses. And here's the quote. He said, "We own stocks based upon our expectation of their long-term business performance, not because we view them as vehicles for timely market moves. That point is crucial. Munger and I are not stock pickers; we are business pickers."
Mm-hmm.
So going back to what you said about changing buses and trying to explain a little bit further of what I was saying of your initial thesis. Well, if you bought this company, and you hear this other analogy all the time about stocks, buy something imagining the market's going to close for the next 10 years, right? Is this something you want to be locked into?
Mm-hmm.
So if you're buying the company for a reason and that reason is not proven uh, false by whatever's changed, and it's just a market price, like with what we're dealing with right now with Russia invading Ukraine. Well, if you've got a domestic small company that'll have that stock price has gone down 20%, but there'll be very little impact on that conflict on this specific stock, this company's business, then that's probably something worth holding to the other side.
Mm-hmm. Mm-hmm.
So yeah, we've covered a lot of biases. The just one other I'll mention that I think is worthwhile. I think I've encountered this more when buying a stock versus when selling. I guess maybe a little bit on both sides, but anchoring bias, anchoring your mind to a certain price. So the price was $10 yesterday, and today it's 10.50, and let's just say in this example, I think the stock's worth 30. Well, 10 versus 10.50 doesn't make a big difference, but I don't feel great knowing I could have bought it for 10 yesterday and it's 10.50 today.
Right. Mm-hmm.
So just knowing don't get your mind anchored to a specific price. Look at the opportunity uh, as a whole. Another one I think that people are dealing with right now is loss aversion. The trying to avoid a loss more than on recognizing a gain. So a desirable investment opportunity is potentially missed. So Erik, this is very similar to what you touched on. Not selling when something's down, when there's something better you could potentially buy. Or
Mm-hmm.
and I kept saying if your initial thesis is wrong, but also just looking at what's going on right now, um, with the markets being being down and people just getting scared or nervous with what's going on and
Mm-hmm.
not thinking long term. I'm going to
Mm-hmm.
rewind us all the way back to the beginning, what Adrian had said while he was avoiding my question, which, which I actually think is a very valuable point. And I had a conversation with someone today about this. With the markets being down, is you really got to take a step back and look at what you're investing for. So the conversation I had with someone today, the markets were down. Well, she's not going to be touching her portfolio for 11 years,
Mm-hmm.
which is plenty of time for it to recover.
Mm-hmm.
Where she's looking at, well, we did so well last year, but now we're down this year, and she was just getting nervous, like something's wrong. And I had to essentially tell her, just be patient, even if we're wrong and things take longer than expected to recover, you've got plenty of time to wait for things to stabilize
Mm-hmm.
and recover, get back to their gains and beyond. So, gentlemen, we touched on a lot of behavioral finance, a lot of biases. Do you have any final thoughts or any final things you'd like to share with the listeners?
I have one, but Adrian, how
Yes.
about you?
Yeah, I have one also. It's herd behavior. I think that's a common one where people are mimicking certain paths in the financial market, whether a stock is going up, they want to get into it. But I think rooted in herd behavior is another behavioral finance concept I don't think really I found in my research, but it's the fear of missing out. I think kind of drives FOMO kind of drives herd behavior, where if a stock is going up, you can see herd behavior being played by more people are buying the stock just because it's going down, or the opposite, people are all selling the stock, so you're going to sell the stock as well. And like I said, what's rooted in that is the fear of missing out, where people know something that you don't, or everybody's making this decision, so you make it as well. And I think now it's kind of outside the scope of finance, it's kind of really hard to do in real life, where if a majority of people are going one way, it's kind of hard to stay stuck in your place and go the opposite way and making that decision. I think that's something that's pretty powerful to do, and especially now where you're hearing all these like new assets coming out, different things people are investing in, it's more powerful than ever, where overnight something could just blow up or just being talked about, where a lot of people are buying or talking about it, whatever it is. And that instance of that fear of missing something that's potentially groundbreaking or could make you a lot of money can be a pretty driving force for some people. So being able to monitor that and really do your research, like we talked about, seeing if this is something viable, something right for you in your portfolio, is something that people should consider.
Agree. I think that's a good explanation for some of the extremes or overreactions on both sides of the market, that the herd behavior. Erik, what was the last thing you've got on your list?
It's just previewing what we're going to address next week.
Please.
So we have, despite the fact that we've come down a little bit off of our peak valuations in a variety of markets, stock markets especially, but also in bond markets, this might seem a little bit of an odd choice, but there are still people that are out there that are arguing our markets are still vastly overpriced, and not just the stock market, but all sorts of assets are in an extremely overvalued state. And so their concern is that if that is the case and markets do correct to something that resembles more normal historic valuations, then whether it's in stocks, it's in bonds, it's in real estate, you name it, that all of us could see a significant pricing of a lot of our assets. So the term that's come to be associated with this is super bubble, and actually you should use the plural of that, super bubbles. And so what we'll do is we'll evaluate, or at least outline and then evaluate that argument that's being made by the person most closely associated with this, which is the organization GMO and Jeremy Grantham. And so we'll look at that argument and others like it and assess what implications that might have for how we all invest going forward.
Yep, I think that'll be another interesting one for everyone out there. So today, as we talked a lot about the different biases in behavioral finance, today I would just encourage you to have a plan in advance. That's in my mind, that's the way to get prepared for anything, right? And for us, the plan, at least for me, multiple strategies, and some of them, there's no possibility for bias because they're driven by set parameters. They're driven by algorithms, and others where I will do the research themselves. So I think that's the homework at the beginning. I think is a big part of the solution when you approach the behavioral finance problem. Thank you for listening. Please like, subscribe, give us 5 stars, tell your friends and family about us. We will be back next week, as Erik said, with an episode on super bubbles. This has been the Retirement Lifestyle Show.